Here we are in the year 2023, and the global economy is in the midst of another slump. However, this time is different from 2008. Consider the changes that have occurred since the last recession and adjust your strategies accordingly. The financial and economic turmoil in 2008 was unforeseen, but the recessions of 2023 will be too. Since the world has evolved, so too must our strategy for being ready for it. The current economic downturn can be traced to several causes, such as increasing prices, international tensions, and technological progress. The outcome is a very different pattern of impact on individuals, organizations, and economies from the 2023 downturn. Let's go right into the video to find out how the recessions of 2023 compares to the one of 2008 and what you can do to protect your finances. Be sure to press the subscribe button and the bell symbol so you don't miss any of our future videos. So, are you ready? Let's get started. According to Forbes, the storm is expected to make landfall around the tail end of 2023 or the start of 2024. The reasoning for it is that there is often a lag of a year between changes in monetary policy and their effects on the economy. Some economists believe the recessions will hit in the first half of the year, while others put the date around the middle of the year. Either way, everyone agrees that the economy will be in disarray in 2023. In the worst affected areas, just the mention of the term recession brings back memories of 2008, when foreclosed upon home placards littered every front yard like gravestones. However, the downturn of 2023 is expected to unfold quite differently, necessitating other strategies and preparations. Unlike in 2008, the fundamentals of the housing market today are strong. In the years leading up to the Great Recession, banks financed risky, reckless subprime mortgages with cheap, easy credit offered to borrowers who are not eligible. After the bubble burst, financial institutions and investors were left with trillions of dollars in worthless mortgages and mortgage-backed securities. Inflation in 2021 drove home prices to all-time highs, but the market wasn't in a bubble phase. Inflationary pressures were fueled by issues in the supply chain, low inventory levels, and lumber crisis. COVID shutdowns, historically low interest rates, and the rise of remote work, but none of these factors point to systemic decay on the scale that underpinned the housing market in the run-up to the Great Recession. Unlike 2008, the increase we have witnessed in the previous several years wasn't predicted on ARM mortgages being provided to individuals who couldn't pay them, says Thomas Sades, CEO of Windy City Homebuyer and a real estate expert. People will still be underwater on their mortgages and there will be some foreclosures, but the number will be far lower than what we saw a decade ago. The first signs of this market downturn are already apparent, and we should expect more declines in property values. But this is a correction, not a recession. Now that you know how the two situations are similar, what steps can you take to safeguard your finances? Well, here are a few strategies to prepare your finances for a recession. 1. Take advantage of a red-hot labor market while it lasts. There is little agreement on whether or not a recession will occur in the coming year, despite at least one forecasting placing its chance at 100%. The increasing demand for people in the labor market, which suggests ongoing economic development, is a major factor contributing to the current climate of uncertainty. The Business Cycle Dating Committee of the National Bureau of Economic Research takes this into account extensively since it is the authoritative arbiter of when recessions begin and end. Almost everything points in the opposite directions from the minor reduction in GDP reported on the product side, said former committee member Jeffrey Frankel in an interview. When the number of open jobs is more than the number of jobless people, you cannot say that the economy is in a recession. That's a long way from being in a recession, he said. Because the increasing demand for employees, many people have been resigning from their employment and seeking other opportunities in a trend known as the Great Resignation throughout the last year. The ratio of job openings to those seeking employment shows that the labor market is expected to remain positive for the foreseeable future. Pew Research March study revealed that there are more upsides to job hopping than ever before, including higher compensation, more opportunities for advancement, and a more manageable schedule. Additionally, workers have been unionizing, striking, and threatening strikes as a response to increased prices. The White House needed to take action in September to prevent a prospective train strike that threatened to shut down large parts of the U.S. economy. Last month, Not only did nurses in Minnesota and Oregon go on strike, but also lumberjacks in Oregon. 2. Keep an eye on the housing market. Rents and mortgage rates have skyrocketed in the United States as a result of the country's severe housing crisis, which is estimated to affect millions of people. More than 30% of the CPI is attributed to housing expenses, and over 40% of core inflation is attributable to housing costs. Similar to the previous month, core inflation increased by 0.6% in both September and August, and is up 6.6% in the year. There isn't much to do for tenants and mortgage payers except avoid an unfavorable market and make do. As President Bob Brooksmith of the Mortgage Bankers Association put it in a statement this week, prospective homeowners are apprehensive to enter into the housing market. Real estate investors are likely to have the same sentiment. 3. Adjust personal finance. It will cost more to use credit to buy things when the Fed raises interest rates, given that the current median estimate forecasts interest rates at 4.6% in 2023. Delaying large purchases and reducing loans now will help you save money as rates are expected to continue rising. It may also become more challenging to have a personal or company loan authorized, as banks grow more cautious about lending to people who may have trouble repaying the loan, especially at a higher interest rate. Commercial banks have been raising their rates in line with the Federal Reserve, but they have not passed the cost of these hikes onto their clients. The FDIC report that the average return on savings accounts is just 0.21%, even though the federal funds rate is now at 3%. As layoffs are more common in a recession, many financial advisors advise family to have an emergency fund ready in case a breadwinner loses their job. 4. Consider investing in bonds. It is difficult to capitalize on the violent swings in the stock market that are formed as a result of the environment of increasing interest rates unless you are a skilled investor who pays attention to the daily movements of the market. In the last several weeks, the Dow Jones Industrial Average has routinely witnessed trading days with gains and losses that numbers in the hundreds of points. While such volatility might be enticing to day traders, it does not provide much of an opportunity for full-time employees in the labor market, since the majority of major stock indexes have seen significant losses this year, with most falling somewhere in the neighborhood of 20%. Investing directly in businesses or index funds may seem to be a high-risk move. However, as interest rates have increased, which has caused turbulence in the equity markets and increased the strength of the United States dollar, the bond market, which is normally less volatile, has experienced a steady rise in returns. The yield on a U.S. Treasury note with a term of 2 years is now at 4.4%, while the yield on a note with a term of 10 years is 3.9%. U.S. bonds are possibly a greater weapon at disposal than they have been for the previous 10 years. According to Jason Blackwell, head of investments at the financial company The Colony Group, Blackwell made this statement in an interview. When 10-year treasuries with very little chance of U.S. default are giving you 4%, that's a very good return, a pretty excellent yield that we haven't seen in nearly a decade, he said. That's a pretty decent return on an investment that we haven't seen in almost a decade. That's all there is to it, guys. However, although the recessions of 2023 may resemble the financial crisis of 2008 in some ways, there are critical distinctions to keep in mind. Understanding the root reasons is important, but so is learning how to mitigate their effects. Don't repeat your prior failures with money. Instead, learn from them and use what you have learned. Put your money into stable investments, spread it around, and have an emergency fund handy. The future may be a stormy place, but if you are ready, you can ride it out. Maintain your edge by always being one step ahead of the competition via knowledge and intelligence. Until then, I wish you all the best in your financial endeavors. Don't forget to leave a comment, drop a like on the video, and subscribe to this channel. Thank you for watching.